11.5%. That is how far Western Alliance Bancorporation beat the earnings estimate in the first quarter of 2026. The Phoenix Bank reported EPS of $1.65 against expectations of $1.48, a clean, clear win. And yet the stock is still sitting around $78, more than 20% below its 52-week high of 97. Something does not add up, or maybe it does. Today on Charged Alpha, we are taking a deep dive into Western Alliance Bancorporation, ticker WAL.
And the headline is genuinely interesting. Western Alliance just $99 billion in total assets as of March 31st, approaching that $100 billion milestone that historically attracts a different class of institutional investor. Net interest income hit approximately $766 million in Q1, up 17% year over year from Q1 2025. That NII trajectory on a bank trading at 1.1 times book value is the setup that gets bank analysts excited.
This is a commercial-focused institution, not your corner community bank. Western Alliance operates across Arizona, California, and Nevada with specialty businesses in technology banking, homeowners association banking, and mortgage warehouse lending. The bank traces its roots to 1994 and has spent 3 decades building one of the most profitable commercial franchises in the Sun Belt. The stock opened 2026 near 79 and has drifted lower even as the underlying business has been performing.
The key question heading into this report was credit quality, whether commercial real estate stress would show up in provisions. It did not. Provision expense came in manageable, the efficiency ratio held steady, and management reaffirmed full-year guidance. The EPS beat is real. The question is whether $78 is the right price for what you are getting here.
Let me set the stage on what Western Alliance actually is, because this is a company that operates in niches most regional banks do not go near. Western Alliance Bank, the main subsidiary, runs 3 core segments: commercial banking, consumer-related, and corporate. The commercial segment is the engine, generating the bulk of net interest income through C&I loans, construction loans, commercial real estate, and specialty lines.
The specialty businesses are genuinely differentiated. The Homeowners Association banking unit is one of the largest in the country. HOA clients are stickier than almost any other deposit type because the accounts are embedded in property management contracts. The Technology and Innovation banking unit went from being a footnote to a core growth driver after 2023, when Silicon Valley Bank's collapse left a gap in the market that WAL stepped in to fill.
And in 2021, they made one of the more interesting acquisitions in regional banking, buying AmeriHome Mortgage for $1.2 billion. That deal added a national mortgage origination and servicing platform, plus a mortgage warehouse lending business that provides short-term funding to independent mortgage originators. So WAL is not just a classic commercial bank, it has a meaningful mortgage finance component.
The geography is a real advantage. Arizona, Nevada, and California are 3 of the fastest-growing commercial banking markets in the country. Commercial real estate and business loan demand runs structurally above national averages in these markets. For a bank that is essentially a pure commercial lender, that is like having a tailwind permanently built into your business model.
36 branch locations, lean for a bank of this size. That is by design. WAL does not compete for retail depositors with big advertising budgets. They compete for commercial clients with deep relationships and specialized expertise. As of Q1 2026, the total loan portfolio sits around $55 billion, and total deposits are around $78 billion.
The business model comes down to this: generate sticky commercial deposits at below market rates, deploy them into higher-yielding commercial loans, and earn a net interest margin that stays above 3.5% through cycles. When that math works, the returns are exceptional. When deposit competition heats up or credit losses spike, the margin compresses fast. Right now, the math is working.
One more piece of context. The company runs roughly 3,500 employees on a $99 billion bank. That is a lean model that translates into a below 60 efficiency ratio in most quarters, which is best in class for a regional bank at this size.
And all of this comes at 1.1 times book value and 8 times forward earnings, a discount we will unpack when we get to the numbers. The moat here is real: sticky specialty niches, Sunbelt geography, and operational discipline. Now let us talk about who is running this company. The company is being led by Kenneth Vecchione, who took over as president and CEO in 2018. Before Western Alliance, he ran AmeriCredit Corp as CEO from 2002 to 2010, one of the largest auto finance companies in the country. He joined WAL as CFO in 2014 and was elevated to the top job 4 years later.
His defining move was the AmeriHome acquisition in 2021, a $1.2 billion bet that mortgage origination and warehouse lending would complement the commercial banking core. The integration has been bumpy in a high-rate environment where mortgage volumes collapsed, but the warehouse business held up. Now that rates are settling, the strategic rationale looks stronger than it did at peak mortgage stress.
Analysts rate Vecchione as a pragmatic, growth-oriented operator who managed the post-SVB 2023 deposit scare better than most regional bank CEOs. He was transparent about deposit flows and capital levels when the market sent WAL below $15 on contagion fears, which helped stop the slide. Management credibility is a real asset in an environment where confidence matters as much as fundamentals.
All right, let's dig into the financials for Western Alliance. I want to start with the thing that matters most for any bank: net interest income. Q1 2026 NII came in at approximately $766 million. That is up from $651 million in Q1 2025, a 17% year-over-year increase. For context, full year 2025 NII ended at $766 million in Q4, and Q1 2026 held that level, a clean hold of the peak.
The net interest margin matters more than the absolute NII number. Management guided for NM of 3.70 to 3.80% for full year 2026. That is the spread between what the bank earns on loans and investments versus what it pays on deposits. As deposit costs reprice lower in a stable rate environment, that margin should expand, which is why analysts are modeling EPS of $9.75 for the full year, even though Q1 printed at $1.65.
On the income statement, total revenue for Q1 2026 was $1,188 million, gross interest income plus fee income. Interest expense was $422 million, giving net interest income of $766. Non-interest expense ran roughly $500 million. Pre-tax income came in at $231 million, taxes were $42 million, and net income was $182 million.
Net profit margin on a trailing 12-month basis is 18%. Return on equity is 12.7%, solid for a regional bank at this asset size. The trailing earnings per share is $8.63 for the full TTM period. Beta is 1.37, meaningfully higher than a more defensive bank. These Sunbelt commercial lenders carry more economic sensitivity.
Valuation. The stock is trading at 8.9 times trailing earnings and 8 times forward estimates based on a forward EPS projection of $9.75 for 2026. Price to book is 1.1 times. And this is where the story gets interesting. High-performing regional banks running double-digit return on equity typically trade at 1.4 to 1.8 times book. WAL is priced like a mediocre bank, despite delivering above-average returns.
Price to sales is 1.62 times on trailing revenue. For banks, the more meaningful metric is price to book, and at 1.1 times tangible book with the current ROTC trajectory, this is one of the widest discounts to fundamental value in the regional banking space right now. The EV to EBITDA metric is not applicable for banks in the traditional sense.
Balance sheet. Total assets are $99 billion as of March 31st. Total deposits approximately $78 billion. Total equity is $7.9 billion. Cash and cash equivalents of $8.5 billion plus short-term investments of $20.4 billion give a healthy liquidity buffer. Net debt position is actually negative. The bank holds more cash than borrowed funds, which is the right posture.
An important note for listeners: Operating cash flow and free cash flow numbers for a bank are not the metrics to focus on. When a bank grows its loan portfolio aggressively, the accounting shows cash outflows. It is not a sign of poor performance, it is growth. The metrics that matter for WAL are net interest margin, return on tangible common equity, and efficiency ratio. All three are moving in the right direction.
The dividend is $1.60 annually, a yield of 2.1% at the current price. Payout ratio is under 20% of earnings, which means the dividend is very well covered and there is meaningful room to grow it as earnings increase.
Overall, Western Alliance's financial health is solid. NII is growing, margins are expanding, credit quality held in Q1, and the balance sheet is well positioned, approaching $100 billion in assets. The main question mark is commercial real estate exposure and whether the rate environment continues to cooperate. The numbers right now do not show a problem, but they require ongoing attention.
Looking at forward estimates, analysts project revenue growing from $3.98 billion in 2026 to $4.29 billion in 2027 and $4.58 billion in 2028. On the EPS side, the forward projection runs $9.75 this year, $11.74 next year, and $13.41 in 2028. If those numbers materialize, you're looking at EPS growth of 37% over 2 years on a stock trading at 8 times this year's number.
That earnings growth trajectory, if delivered, would be exceptional for a bank. The caveat is always credit quality. A single bad credit cycle year can wipe out 2 years of EPS growth in banking. The forward estimates assume stable credit. Right now, Q1 supports that assumption.
And the quarterly revenue trend tells an interesting story. WAL ran around $1.2 to $1.3 billion per quarter in 2024 before stepping up meaningfully in the second half of 2025, hitting $1.4 billion in Q3 and Q4. Q1 2026 came in at $1.19 billion, slightly below the Q4 pace. The sequential step down is seasonal and tied to the rate environment, nothing fundamental. What does the Street think about Western Alliance going into the Q1 2026 report?
Broadly positive. 10 analysts covering 6 with buy or outperform ratings, 4 on hold, 0 sells. Consensus price target is $98, implying about 26% upside from the current $78 level. The target range runs from 82 on the low end to 115 on the high end.
The KBW and Barclays calls are the most influential. KBW maintained outperform in April 2026, citing the NII trajectory and the PB discount relative to higher performing regional peers. Barclays has been consistently overweight on WAL and reiterated that view in early April. These are the two firms that specialize in financial sector coverage, so their endorsement carries weight.
The contrarian note came from UBS, which downgraded from buy to neutral in early April 2026, citing macro uncertainty around commercial real estate and WAL's sensitivity to rate expectations. That downgrade removed some upward pressure on the stock heading into earnings. Wells Fargo, which had been bearish, upgraded from underweight to equal weight in March 2026 after acknowledging the post-SVB discount has largely normalized.
On the Q1 earnings result, EPS of $1.65 beat the $1.48 estimate by 11.5%. Revenue of $1.19 billion came in above the $1.17 billion estimate. Both beat a clean quarter that gives the bull thesis more credibility heading into Q2. Management also reaffirmed full-year guidance at $9.50 to $10 EPS, with no cautionary language on credit quality. Let me lay out the bull case for WAL, because I think there are several independent catalysts that could close the gap between $78 and $98 over the next 12 months.
Go for it.
Catalyst 1. The NII expansion story is just getting started. WAL is asset sensitive. As deposit costs reprice lower, the margin should widen from 3.7 toward 4% through 2026 and 2027. That incremental spread on a $99 billion asset base flows almost entirely to operating income. The 2027 EPS estimate of $11.74 and 2028 estimate of $13.41 are serious earnings growth numbers at 8 times forward multiple. Catalyst 2, the $100 billion asset milestone. When a bank crosses this threshold, it enters the coverage universe of larger institutional investors who require a minimum asset size. WAL is right there. Once they cross it formally, expect a re-rating from the current 1.1 times book toward the 1.4 to 1.6 range that larger regional peers command. That multiple expansion alone adds 30 to 50%. Catalyst 3, and this one is underappreciated, is the Sunbelt organic growth engine. Arizona, Nevada, and California are consistently generating above-average commercial loan demand. WAL does not need a big acquisition to grow. The market is growing around them. That kind of embedded growth without acquisition risk is worth paying for in any credit environment. Catalyst 4 is the valuation disconnect. At one point, 1 times book versus East West Bancorp at 1.78 times, the market is pricing WAL as if its 12% ROTE cannot be sustained. The discount between these two Sunbelt commercial banks is hard to justify on fundamentals alone. If WAL's returns hold, the discount should close.
And Catalyst 5 is the insider buying, the board members purchasing stock in the open market.
Exactly. 2 open market purchases in the $74 to $78 range in early 2026 from people who sit in board meetings and see the pipeline. Not scheduled selling, deliberate buying at depressed prices. One of the strongest conviction signals you can find.
Now let me take the other side. Bear risk 1 is commercial real estate concentration. WAL has meaningful CRE exposure, office, hotel, and multifamily loans in markets still working through elevated vacancy rates and cap rate pressure. If the CRE cycle turns, provisioning rises sharply and the clean Q1 credit metrics will not stay clean. The history of regional bank blowups is full of CRE surprises that looked manageable until they were not.
What is bear risk 2?
The beta problem. At 1.37, WAL amplifies every macro shock. A recession, a rate spike from tariff-driven inflation, or renewed bank sector stress hits this stock harder than lower beta peers. You get extra return when things go right, and extra pain when they go wrong. That asymmetry is the price of admission for this kind of regional bank. Bear risk 3 is the regional banking sector discount that has been present since March 2023. Any negative headline, a bank failure, a CRE credit event, a deposit outflow story anywhere in the sector can send WAL down 10% in a session, even if the specific news has nothing to do with them. Co-movement risk is the tax you pay for owning a high beta regional bank. Bear risk 4 is AmeriHome. The mortgage unit has been a drag in the high-rate environment. Origination volumes have not recovered to the levels that justified the $1.2 billion purchase price. If rates stay elevated, the warehouse lending and servicing businesses face continued pressure. The integration thesis requires a mortgage market recovery that has not fully arrived, and bear risk 5 is the regulatory cliff. Crossing $100 billion in assets triggers enhanced prudential standards, more capital requirements, stress testing, and a compliance burden that will add costs and could limit loan growth. WAL is going from a mid-size regional bank regulatory environment to a near systemically important bank environment. That transition has real costs that are not fully priced in yet.
Let's look at how Western Alliance stacks up against its closest peers on price to book. The right metric for banks.
WAL trades at 1.11 times book. Alliance Bancorporation, another Sunbelt commercial bank, trades at 1.02 times book, slightly cheaper but with a lower return profile and less dynamic loan growth. Fifth Third Bancorp, a larger Midwest regional, trades at 1.45 times book with a return on equity around 11.9%.
And East West Bancorp, the premium name in the peer set, trades at 1.78 times book with a 17% return on equity. That premium is earned through a differentiated commercial banking niche. East West is the comparable that makes WAL look most undervalued. Similar commercial focus, but 38% cheaper on price to book despite only a modest ROE gap.
The market is giving WAL no credit for the NII expansion cycle. If ROT holds at 12% and they execute on NIM guidance, the stock should naturally migrate toward the 1.4 to 1.5 times book range occupied by Fifth Third and quality regionals. That convergence trade is what most of the buy-side models are targeting. The options market is sending some signals on WAL. The put-call ratio post-earnings is 0.82, more calls than puts, a modestly bullish posture. Implied volatility is at the 52nd percentile, elevated versus pre-earnings but not at stress levels. The stock had a clean beat, so vol compression should continue as we move away from the event.
The key levels to watch in options are the May $82 calls and the June $72 puts. The May 82 calls represent conviction that the stock can recover 5 to 7% from current levels in the next few weeks. The June 72 puts are the hedge position, protecting against a break below the recent support zone around $73 to $74.
On insider activity, this is actually a positive data point for WAL. 2 board members purchased shares in the open market in the $74 to $78 range in early 2026. These were not scheduled 10b5-1 transactions. These were deliberate open market buys close to where the stock is trading today. 3 executive sales occurred on scheduled plans, which is routine. The board-level buying at these levels is worth noting.
Open market buying from insiders at a depressed price level, with no counterbalancing open market selling, is one of the cleaner positive signals available. It does not guarantee the stock goes up, but it suggests the people with the most information believe it should. Let's bring it all together on Western Alliance Bancorporation after the Q1 2026 earnings report.
The fundamental picture is cleaner than the stock price suggests. The EPS beat of 11.5% was not a fluke. It reflected genuine NII growth, stable credit quality, and a lean operating model. Management's reaffirmation of $9.50 to $10 full-year EPS guidance at a price of $78 puts the forward multiple at 8 times. You are paying 8 times earnings for a bank approaching $100 billion in assets with a 12% return on equity.
The risk is real. CRE concentration, high beta, and the regulatory cost of crossing that asset threshold. Anyone buying WAL here needs to be comfortable with those risks and have a view on commercial real estate staying manageable through 2026 and 2027. This is not a low volatility income play. It is a higher beta value bet on Sunbelt commercial banking.
The key metric to watch is Q2 2026 net interest margin and the pace of commercial loan growth. Management guided for NIM of 3.70 to 3.80%. If Q2 NIM prints above 3.75 and provision for credit losses stays below 40 basis points annualized, the NII expansion thesis is intact and the bear case loses its main argument. If NIM compresses or credit losses accelerate, the story changes materially.
One closing thought. Western Alliance has been here before. In the spring of 2023, the stock briefly traded below $15 on SVB contagion fears. Everyone thought regional banking was broken. The company demonstrated its deposit stability, held its credit metrics, and the stock recovered. The question today is whether the current discount is another overreaction, or whether the CRE and macro concerns are legitimate precursors to something worse.
And that closing note from Kenneth Vecchione captures the management philosophy well.
Quote, "Our goal is simple. Be the best commercial bank in the markets we serve. Not the biggest, not the loudest, the best. We have built this one relationship at a time, and that is how we intend to keep growing it." That is Kenneth Vecchione, President and CEO of Western Alliance Bancorporation.
Classic long game thinking.
If you want to track how Q2 2026 unfolds for WAL, or run your own screens on regional bank valuations, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, and commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you. Check it out at chargedalpha.com. That is going to do it for this episode of Charged Alpha, Western Alliance Bancorporation, ticker WAL, Q1 2026. Thank you for listening. Until then, I am Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall